Welcome to our fireside chat. Today, it is my privilege to introduce Katie Stockton, founder and managing partner of Fairlead Strategies. Fairlead's an independent research firm and registered investment advisor that specializes in technical analysis and tactical investment strategies. Katie is a portfolio manager of the Fairlead Tactical Sector ETF, or TAC, launched in 2022. It uses sector rotation and asset allocation to navigate changing market conditions. She has over 25 years of Wall Street experience delivering technical research and strategic insights to institutional investors. She's held the Chartered Market Technician certification, the CMT, since 2001, and has been a contributor on CNBC and quoted in financial media such as Barron's, MarketWatch. So it's our pleasure to welcome her here. Katie, welcome, and thank you for giving us your talk today.
Of course, Greg, good to be with you today.
So I thought we'd start with some questions on the basics of technical analysis. What is technical analysis and how does it differ from fundamental analysis?
I would say that at its foundation, technical analysis is the sort of evaluation of price trends using various indicators and tools to try to determine not only what the prevailing trends are, but if they're coming to an end. And that's really the hard part, isn't it? And it's based on the supply and demand dynamics for any given security. We have to use publicly traded securities for technical analysis to be applicable. But we can look at anything. Anything that has a price is certainly something that we can have an opinion on as technicians. And it's a very accessible discipline. It's something that people can keep on their side in their investing and in their trading. It's designed to understand market psychology and sentiment and how that's influencing prices. We often look at the stock market, but it's very applicable to commodities and FX, fixed income, you name it. And we're usually looking for opportunities, whether it's a turnaround or a breakout or just simply a very strong trend, one way or the other, to take advantage of. We see technical analysis as the ultimate complementary discipline to other disciplines. We don't often use it or recommend using it as a standalone discipline. We think it's a great add on to fundamental research, to macro analysis, because then you have a stool with more than one leg. And when you have these things all supportive of your trade or your investment, that's, I think, when you can get the most powerful takeaway from the charts.
Great. Well, you've mentioned a bunch of things there. What is a technical indicator? And would you be able to help us look through different categories of those indicators?
Of course. So the technical indicators are mathematically derived from price. So they're mostly derivations of price. Sometimes we will incorporate volume and external metrics like sentiment and leadership data, breadth data as well can be relevant. But the primary indicators that we use, I would categorize in three ways. The first category would be trend following and momentum. So looking at the prevailing trends, trying to understand what is the dominant feature over whatever time horizon is being analyzed. And then we also use overbought, oversold metrics. And this is where the stochastic oscillator, for one, will fall, a very helpful tool in discerning whether a trend is exhausting itself one way or the other, among others. And then we also use relative strength indicators. And those are essential in just evaluating relative performance, even simply based on moving averages or price trends as ratios of a price to price, just to understand if something's outperforming or underperforming and where there might be turnarounds underway. So it's those three categories taken together that sort of creates our discipline and is the stuff of our methodology. Not every technical analyst uses a lot of technical indicators. We do tend to use quite a few. It's just what suits our process and the way we think about the world. We like to try to take out some of the biases that the market often gives us. We always have opinions, and you can't argue against the mathematical indicators. Often they are a binary takeaway, a buy or a sell signal, up or down, positive, negative, overbought or oversold.
Well, a lot of people are familiar with trend indicators like moving averages. I think the momentum indicators are less well known. Could you explain the difference between those?
Right, the moving averages are super helpful because they can eliminate the noise that is inherent to any security by smoothing it out, looking at historical prices. And it's a very easy tool to apply and simple in terms of its takeaway. Typically, if you have a flat moving average, you're probably looking at something in a trading range over the time frame that's indicated, and so on. When price is above a rising moving average, that tends to be an uptrend that has some strength behind it, and vice versa. We also sometimes will look at moving averages as support and resistance. Support is a potential area of buying pressure on a chart, and resistance is a potential area of selling pressure. And for whatever reason, maybe just because there's so many eyes on it, something like a 200-day moving average will become a good gauge of support or resistance. So sometimes we'll look at the moving averages that way as well. Like a breakout above the 200-day moving average could be informational. It tends to sort of exacerbate the trend. Now, we use the momentum gauges and overbought, oversold metrics that are derived from these momentum inputs to help us understand if these trends are likely to continue or if they're tiring out. And that's essential information. I think it's quite easy for us to all look at a chart and say, well, this is an uptrend or this is a downtrend. But it's harder to know if that trend is likely to give way to a big correction one way or the other. And that's where these tools like the stochastic oscillator really come in handy. They'll give you, again, close to binary takeaways. There's always nuances, of course, but when used in combination with the momentum gauges, they can be very powerful to that end.
Well, I like that even if there's this binary indicator for something like an overbought, it's still at a prescribed level. For example, you might have overbought at 80 or 70 and oversold values on the lower side. Can you give some justification as to why those levels, let's say an 80 and 20, are commonly used as opposed to 70 and 30?
Of course, well, the stochastics as an oscillator is sort of shifting between 0 and 100%. So it's in our interest to look for extreme levels within that context. 80% and 20% are somewhat standard. And I think that's not accidental. It does capture extreme moves, and it tends to be the right frequency for investors in determining whether a major sort of corrective phase is in store over the time frame in question. So it's really, I think, just market history that's allowed for those levels to work for the vast majority of people using them as their standard parameters. There are other overbought, oversold metrics that will use other levels. So the RSI, which stands for Relative Strength Index, this is more of an internal relative reading versus an external comparative reading. It looks at a security relative to itself, essentially. That is commonly used against 70 and 30% as the thresholds there. A different indicator, but the design is somewhat the same in terms of we want to determine if something is overextended one way or the other. So both indicators, which are trying to arrive at the same conclusion, can be helpful just from different perspectives. What we always recommend to folks is just not to have too many indicators that are trying to achieve the same end, because then you'll have maybe confirmation bias in choosing the one that's closer to what you feel as opposed to maybe what actually is. And so to have one, none of them are perfect, mind you, but one that you come back to consistently, I think that's where the most value is, not just for an overbought, oversold metric, but more broadly, just to come back to the same tools time and time again is exactly what a methodology is, right? And that systematic approach we think adds the most value. So if an investor can apply these tools on a regular basis, we think that's the most powerful way to use technical analysis. And it's often the hard part because it's not everyone's day job like it is ours. So we understand the need with that in mind to keep it pretty simple. And so what we've also recommended is that for each of those categories, the momentum-based tools, the overbought, oversold metrics, and relative performance metrics, to have maybe one or two indicators that check those boxes. And that way your toolbox isn't so unwieldy that you can't track it regularly. It is a very visual science in a way, and in that way it's somewhat art as well, in that you're always just watching these signals unfold in real time.
Well, I can see how, as a portfolio manager, the tools of technical analysis itself are like managing a portfolio in that you have the different categories, and within each category, you have different implementations of different indicators and levels that they can be used. For example, when you build a trading strategy, you might use these moving averages, you might use stochastics. If you were to use stochastic, would you use it as a primary signal or a confirmation tool? And how did you come to that decision?
I use it both ways, in fact. So, as a primary tool and also a confirming tool. The reason I use the stochastic oscillator, for one, is because my mentor did. So it's not because I was inspired by the textbook featuring it, and that can make it sort of get lost, right, among all the other indicators and tools out there. It was simply because somebody taught it to me and it made an impression, and then ultimately suited my investment sort of process. Now, different indicators will be, I'd say, relevant over different time frames, but we found that the 12 period stochastics really do suit our typical time frame as well, in terms of the research that we're doing for clients, and also in terms of the investment decisions we're making for the TAC ETF. So we found great success with the stochastics, and we do use it in combination with those trend following gauges. We found that when you're referencing something as simple as a moving average, perhaps, to make sure that the primary trend is indicated, that's going to add a lot of value in terms of how much weight you're giving to the stochastic oscillator. And that's a very important takeaway, in that it's not as simple as just using stochastics or just using something like a moving average. There's a little bit more to it in order to get the most out of technical analysis. But that's where we get into sort of multi-factor models and things that are perceived as complex, but it's still very visual. And I think you can trust that a stochastic oscillator, when you're looking at a security in an uptrend, it will have more false sell signals, and vice versa. In a downtrend, it will have more false buy signals. And by false, I mean, well, maybe it worked for a very short duration, but ultimately gave way to resumption of that trend. So you want to honor the trend, I would say, first and foremost, and then allow the stochastics and your weight that you're giving the stochastics influenced by that input, that trend following input, on sometimes a sort of a longer term time frame, especially. So I might go to a monthly bar chart, look for the primary trend input, and once I'm convinced I have a good sense of that, well, then I'll maybe look at a stochastic oscillator on a weekly bar chart for market timing purposes.
Well, I like how you're using it as an intuitive and a second source of opinion about the market in conjunction with things like fundamental. And then it's also visually confirming what you see and visually inspiring perhaps the signals. Could you also backtest that type of stochastic strategy? And what metrics might you use, let's say, besides a win rate?
Yeah, I mean, you could certainly back test any of these indicators because they are sort of simple mathematical tools. What I think you'll find is that if you back test really any of them, whether it's a MACD, which stands for moving average convergence divergence, or the stochastic oscillator, or the RSI, I think you'll find that as a standalone tool, they're not great as a trading system per se. A stochastic oscillator also is not really a system, in that it doesn't give a buy and then a sell signal. It can give three buy signals and then one sell signal and then a couple buy signals. So it doesn't have that same toggle that is often welcome in a trading system. So I wouldn't recommend evaluating these indicators as a standalone, but rather as part of a bigger sort of process or methodology. And that makes it a bit more complex, but I think still worthwhile. So, as an example, you might say, okay, well, we're going to evaluate the stochastic signals within the context of the longer term moving average. So, even just adding that one overlay, that the results in the back test should be much more robust and helpful. So any back test with technical tools, I think you're looking for not only win rate, but percentages, of course, and risk. I mean, we're using technical analysis, I'd say, to discover opportunities, but really primarily on the behalf of our clients to help them manage risk and limit drawdowns. Because in their portfolios, as much as it might be more convenient to just buy and hold, many of us can't really afford to suffer through really big drawdowns, especially if we're close to retirement or have, a need for funds in the near term, that type of thing. Not to mention, when you see a limited drawdown, you're rebuilding your portfolio from a higher sort of bench there. So we really are very interested in managing risk through that sort of elimination of the big drawdowns. And that's something else that we like to analyze when we're testing these tools is, how far did it let us go one way or the other? We also like to evaluate correlations. So is something highly correlated to an index or not? And that's sometimes welcome, sometimes not. And just your typical sort of statistical metrics, standard deviation, things like that. So all of that's very relevant, and that's sort of the next level. But I'd say that for a novice, someone who's just getting into technical analysis, to start with the visual elements of it, and I think they'll start to see where it adds value.
Yeah, I think that makes it very accessible because although all these things have mathematical formulas, some which may be very easy, like a moving average, and others which will be a lot more multi-step or at least intricate in its details, they all lend themselves nicely to overlays on time series or looking at how two time series relate to each other, crossing or how they're correlated or they're spread over time. So maybe we could look at some of these charts. Perhaps we could look at one and then we'll take some time to look at the interpretation that you would have in that chart.
Of course, yeah. If you bear with me, I will pull up a good example that we have prepared. I think there's a lot of good examples out there. So, we're just kind of choosing one that we use regularly here at Fairlead Strategies. And we find that with the sort of multiple time frames that we get the most value out of these tools. So we're often looking at the monthly bar charts, the weekly bar charts, and the daily bar charts for our takeaways. Okay, perfect. So I think this actually will help everybody to understand what we're talking about in a way. The visual elements key when it comes to charting. And you see in the top window, that's price. These are open, high, low, close bars, very standard bar chart with a 12-month moving average. The 12-month is not especially relevant for support or resistance, but it gives you a visual indication of the prevailing trend. So we like to use that on a long-term basis. And you'll see in the bottom window is our stochastic oscillator. So we put it in the overbought, oversold camp, but it truly is a momentum gauge. And you'll see we have denoted turning points that we care about in the stochastics. It's really important to note, so where you have this 80 threshold and this 20 threshold, those are the extremes, but those aren't the signals in our work. We use the stochastics in a way that I'm not quite sure is very common or otherwise, but it's just the way that we've found that they add the most value. And we're looking not just for when a security like the dollar index or an index like the dollar index gets above the threshold, but rather when it turns down and goes back below. That's where we feel we have a sell signal. So an overbought reading in and of itself is not bearish, nor an oversold reading bullish. It's when you see that turning point, which does reflect a momentum shift. And that's where we feel like they're most actionable and where we actually get signals that we think are worth imparting. So that's why we've denoted these signals with red arrows on the downside. See, it's when the stochastics, which have two lines here, I'll explain that, give way to a crossover and a downturn back below that 80% level. And that's where we get our so-called sell signals. And you can see on the flip side, the buy signals are denoted by the green arrows. And that's when we see a sub 20% reading give way to an upturn back above 20%. And that can be very informational. You can see just as a visual takeaway, we won't get too deep into the numbers here, but the green arrows tend to be closer to important lows for the dollar index, and the red arrows tend to be closer to highs. It is a good example because the dollar index has a sort of propensity to be range bound at times. And you'll see that the within a range, these signals tend to really be best, most helpful to identify these volatile swings and when they're coming to an end. So we really value it in trading range environments as an oscillator, right? Most oscillating measures will be super helpful in ranges, even to the point where after a strong up move, like we saw between 21 and 22 in the dollar index like this, the sell signal was really quite timely after that very steep, almost parabolic up move. And that's when we saw the stochastics come back below 80% after an elevated reading. Just briefly on the calculation of this indicator, it's looking at a high low spread of 12 periods for us. And it's looking at where price is closing relative to that range. And if it closes continually towards the high end, it becomes more and more overbought by these metrics and vice versa. And we also have a smoothing factor. You'll see that the blue line, that's basically the data line. And the red line is a smooth version, a 3-period smoothing of that, just a moving average effectively of the data. And that is there by design. It's there to generate signals, crossovers, and just add a bit more information, just like the bar charts with the open, high, low, close. Rather than a line chart, we feel we get some more information from those sort of inputs.
Well, I'd love to talk about buy signals and sell signals. So suppose you saw the percent K crossing above the percent D at 15 level, which is oversold, then if the stock is in a downtrend, would you take the buy signal in that case? And why
It's
or why not?
It's a great question. The percent K would be like the data line, and then the percent D. There's some other nuances to it, but that's generally the smooth line that you see. So when you see one cross above the other with the data line, which is blue here, that should be sort of a trigger point. We care most about when it comes back above 20%. So, we start paying attention perhaps when it first crosses over, but it's really when it comes back above that 20% threshold that we feel like we have a buy signal in a downtrend. I'm going to try to advance to the next slide here to show you a different environment. And here's actually a pretty good example. This is a zoomed in version of the dollar index on a weekly bar chart. And you'll see that in this downtrending environment for the dollar index, this was a pretty bad signal. So it spent just a week or so above that oversold threshold. So we probably would have taken that for face value, except for the fact that notice the slope of the moving average, right? So as a trending input, we knew at the time that this was a downtrend, right? That's pretty obvious in hindsight. But with that pointing lower at the time, it made this signal less impactful in our research. So we're going to give it less weight when the moving average is pointing down, or when we have other inputs that would suggest it's a downtrend. We also really consider breakouts and breakdowns to be some of the best information we can get from charts. So if you notice, the dollar index had pivoted and found support multiple times in this area. And at this point, it had already broken that support. And therein, that signal became lower conviction. And that's basically the nature of a downtrend, right? You're continually taking out support levels, and those buy signals will be made lower conviction with that in mind. They still can be helpful. In fact, this one here was helpful. Maybe not for an indefinite duration, but for a short duration. And you can see the same on the upside. This is that very strong, almost parabolic up move that had the one sort of timely sell signal on the monthly chart. But you can see on the weekly chart, there's multiple sell signals. And they're denoted by the stochastics falling, not only crossing over, but falling back below 80%. And you can see that at each of the red arrows, there was only, a couple few weeks that we saw corrective action. So they were generally found near corrective phases or consolidation phases when it goes more sideways. ultimately culminating in a very timely sell signal. But it's just a function of reconciling how is that moving average shaped? What is the relationship between price and also these support and resistance levels? And that'll help us understand how much weight we're going to give to these overbought and oversold indications.
Well, I like how you're using a monthly and a weekly time frame because I think you get a a fuller picture of the information. Could you comment more about how you use the different time frames together to perhaps justify an investment decision?
Absolutely. We feel that a lot of traders would be more interested in the shorter term time frames, but they should also have the context of the longer term time frame to help influence their decision making. So we tend to often focus on the intermediate term trend, which we consider to be in sort of like the maybe 6 week to like 1 quarter type of duration, maybe up to 4 months at times. And we do that because we feel like there's kind of swings, right, that we can leverage over that time frame. And so that's also where a lot of our clients tend to focus. They want to put up good numbers as portfolio managers on a quarterly basis, not just on a 3 to 5 year basis. So they're pretty attuned to these volatile swings that they can ideally leverage through the use of these indicators. But we always want to contextualize this monthly. So here, for example, on the dollar index monthly, we have an active sell signal at that time, which may lead us to give less weight to these buy signals on the shorter time frame in the same way that the sort of declining moving average is doing. So we will just use, I'd say, the bigger picture to give us a sense of the overall picture to influence our decision making. Whereas the zoomed in look, whether that for you is a weekly chart or a daily chart or even a 60-minute chart, that might be where you're getting your market timing from. And by market timing, I mean trying to buy low and sell high, trying to put the odds in your favor for a timely entry in a position and timely exit in a position. That's where we zoom into these shorter time frames. And the takeaways for the signals, of course, are going to be different. If you had an overbought sell signal on a monthly chart, that will have implications for months. And if you see it on a weekly chart, it will have implications for several weeks, perhaps.
Well, when I look at this chart, I think on the right side, you see an oscillation. And on the left side, you see, let's say, a stock if it were making new highs. How would you use that information? Like, suppose you had a stock that oscillated between 50 and 60 for several months. How would you use a stochastic differently than for a stock that made new highs, which maybe represents more of the left side of this chart?
We would give more weight to the stochastic oscillator and any other overbought or oversold inputs in that range bound stock versus the one that's at new highs or in some kind of parabolic uptrend. For those, for the strongly trending securities, we would give more weight to the moving averages, more weight to the MACD indicator. We have a couple other tools that we like to sometimes visually reference to that end. So as an example, right now, we're focused on the S&P 500 because it has had such a strong trend. We're watching the slope of the 20-day moving average as a primary input right now. It's very simple, and yet it's a great way to eliminate the noise, of which we've seen a lot of noise in the daily stochastic oscillator, where if you had just taken that for face value, you would have been whipped in and out of the S&P 500, multiple times, and that's only within the last few weeks, really. So we will give more weight to the moving averages for those trending stocks.
And what if the information you get might be contrary in that, let's say, price made a lower low at 95 and stochastic made a higher low at 25? And to make it fun, let's say volume is decreasing. How would you interpret that and form an investment decision?
It's a great question because what you're talking about there is effectively a divergence, and they're not that common. But when we do see them, we certainly pay attention to them. On this chart, I would say that the one that stands out to me is here, where you had an equal low in price, or you could argue it's a lower low. and a higher low in the stochastic oscillator. So what it means is that it's getting less bad on the downside. So the momentum on the downside isn't as strong. You can see that also in some other metrics as well. So, and volume, perhaps if volume isn't quite as strong on the downside, that might be another input for someone. So we would, give more weight to this signal by the nature of it having a higher low against prices equal or lower low. So these are definitely things that can be visually sort of additive, especially when we have multiple indicators that we can analyze to that end. I would also say there's a couple of nuances. This is a chart of the Bitcoin ETF GBTC. And you'll see here more signals, pretty high frequency on the weekly chart, but some very, very timely signals on both the buy and the sell side, and certainly some divergences that we feel had some impact. As an example here, we had a lower high in the stochastics and a higher high in price terms. And that, of course, preceded a significant correction for Bitcoin over this time frame. You see here, too, this sort of negative divergence, an equal high and a lower high in the stochastic oscillator. So it's sort of a nuanced takeaway. We do find that often, and I don't know exactly why this is the case, but we see the first overbought or the first oversold condition retested. So you'll see a stochastic upturn and it comes right back down for a retest. So at times we'll say, well, I want to see a little bit more out of it. For example, this signal, it really was untimely with hindsight. And you can see how strong the downside momentum was. There was a breakdown, even on a gap down on the chart. So this first signal, we might have said, let's wait to see if we can get a second signal out of it just for confirmation. So there are some nuances like that that we like to focus on. And this is, I think, the added benefit of the visual element. So the more that you watch these indicators and look at these charts, the more comfortable you'll get with their sort of, I guess, timeliness and how they can help you, and not looking at any of these things as the holy grail of technical indicators, but as ways to just put more probabilities in your favor as you're considering an investment.
I can certainly see the advantage of the visual in it, but there is a good background needed in a way to extract the rich information you've been describing. Are there any other charts that you'd like to share with us that you could provide an interpretation?
Of course, yeah, we can look at the monthly of Bitcoin, which of course has limited history relative to the dollar. But another good example of where the stochastics can add value as just one overbought, oversold metric, especially in combination with any kind of trend following gauge. Some great entry points and exit points. Not all perfect. This was obviously a pretty poor sell signal back there. But overall, a pretty good record in terms of discerning these important peaks and troughs on the chart. You'll see that it isn't, as mentioned, a trading system where it always has a buy signal to every sell signal. So you have to, consider it as just one input to that end to try to understand if something's getting overdone. So right now, you would say that the signal has probably worked itself off. The stochastics are still pointing higher. We don't have a downturn or crossover to worry about at this time. But you can see also that the stochastics are pretty darn close to 100%. So we would just be keeping an eye on them at that level because it's more likely to see a downturn once it gets that extreme. So we will also, consider the stochastics, as mentioned, trading ranges in a way that in, the uptrends that are strong, they might be less helpful. A good example of that is this IWM ETF, which is a small cap ETF. And you can see a trading range environment is highlighted here, and the timely signals are just very reliable. So if you could take these signals and then just note also that the moving average is flattened out, basically. That can be a great input, and yet still added value in the corrective phases as well, both on the upside and on the downside. But you have to honor the fact that the trend is still intact and just treat those as shorter term signals.
So given this rich set of signals, there's a lot of ways that even if two technical analysts use the same tools, they could use them very differently. And so I think this CMT program would be quite interesting because, as you mentioned, you were inspired by your mentor to follow along a certain way. So I'd say not all CMTs would even learn the same things because they might see how the tools are used differently. So if people are interested in this chartered market technician certification, how might they get started?
Well, we recommend it to anybody who's passionate about markets. It was a great education for me and for my colleagues. We learned a lot, and there's a lot more out there than what you've seen today, of course. And we encourage people to do their own research. The CMT program, think of it as sort of a CFA for technical analysts. It is a 3-level exam. It takes, I'd say, at a minimum, a year and a half, usually more like 2.5 years to complete. And it's a professional designation. So you can add the CMT behind your name, just like you could, if you're a CFA. So it is a great differentiator if you are in the profession, and you don't have to be a technical analyst by trade, but many financial services professions can benefit from the designation, and that if they're an advisor, financial advisor, it's a great differentiator, or portfolio manager, trader. So there's a lot of use case for technical analysis and for that designation. But even just for someone who's interested in learning, the curriculum that has been designed behind the CMT program, I think gives a great swath of what's out there. And it goes deep enough to be added value if you decide to kind of adopt it yourself, but enough broad enough also that you can see that there's a multitude of tools out there for you at your disposal. So, we really recommend the curriculum for anybody who's interested in technical analysis. They have sort of snippets from various experts and from various texts to have access to these tools.
Yeah, it's interesting from my perspective because aside from using it professionally, I also put it into the program where we touch upon basic technical indicators, much more basic than we even discussed today, that get used in factor models. So someone might throw different technical indicators as a factor to simply help get a better prediction or forecast of a point or two ahead of time.
Mhm.
And that's to say that there's classes of fundamental or macroeconomic and technical factors that can all help in some type of a time series regression or cross-sectional regression. Again, simply to either predict, or if it's on the risk management side, in some type of attribution to help explain why the return profile did explaining the performance along those.
Yeah,
So
for sure. I think it's a great input, and a lot of algorithmic traders will adhere to these tools. And it can be as simple as looking for a breakout above a 200-day moving average, or obviously far more complex than that. But I think there is so much value in understanding the supply and demand that is evident in price. The assumption is that all the known information out there does get sort of incorporated into the price. So, as much as that's hard for some folks to hear, everything does come down to one buy or sell decision. So, not to be too cynical, but price really is key in terms of investing. We just need to keep these trends on our side. And that's what a lot of the algorithmic traders are using, as an input, momentum gauges, things of that nature.
and looking at the creativity side of it, it seems endless into the combinations of indicators, how they're set, how they're used. And it was really refreshing to hear is how well you've applied this because uh, I would say very few technical analysts would be able to create and run a portfolio, but you've taken it to the level where you have you have both a good in the trenches view of these indicators, as well as a strategic view to show that you're balancing among stochasticity and moving averages and momentum. So you're a human version of creating factor models, which many times we're throwing thousands of time series into machine learning algorithms and hoping that they distill it into a small but meaningful set of insightful factors. And your experience has shown that you can do that on the technical side, and to the point where you're running, a tactical sector ETF for several years with doing sector rotation asset allocation.
No,
So
I appreciate
this is
that. And
a great way to really show technical analysis to our audience, because it can be even more technical than it might seem on the surface, because there's this strategic and intuitive element that come with that with experience will take it to the higher levels.
for sure, it can inform any decision making. And I think it's a great tool married with quantitative analysis, right? It's a different way of looking at technical analysis through some of these models. It's a different lens, but it's analyzing exactly the same thing. So if you can set a series of rules around your indicators, well, there's great value in that. And then if you can combine them in a way that you're weighting them appropriately for different environments, then I think that there's a real trading strategy in that. And it takes some work, but it's actually fun and interesting. And I think you'll tend to learn a lot about yourself and your own sort of process along the way.
Well, this has been great. Again, we've been talking with Katie Stockton, founder and managing partner of Fairlead Strategies, who has taken the CMT designation to its high levels by managing a portfolio, managing a staff of people that do technical analysis, and sharing with us the insight and advantages of this methodology. So, Katie, I want to thank you for coming on our fireside chat today, and it was great having you. And uh, good luck with what you're doing, and I hope that people watching get excited about CMT. Is there any specific advice that you'd give if they wanted to follow up on the training, or finding information locally about how to get those certifications?
Yeah, by all means, I would start with the CMT Association's website. It's a great resource and will help you learn about the CMT designation. And I would maybe discourage using social media as your access to technical analysis because that is where the confirmation bias will come in strong. But I appreciate those words, Greg, and I hope that folks watching are inspired to at least look further into it and to incorporate technical analysis in their own trading.
Okay, thank you. And that will conclude our fireside chat. We'll see you next time. Thank you.